Will the most hated rally continue? Hello everyone, this is Ahmed Saleh and this is a weekly market recap. And now to the key messages. Market was able to move higher after a very busy week. 2 out of the Mag 7 went up after the results, Google and Amazon, and 2 went down, Facebook and Microsoft. 1 was flat. So we have a split in the Mag 7 results. We had also the Fed meeting. He pointed out that December rate cut is not guaranteed. This is called the most hated rally because it's defying all expectation. So the valuation is high. We went up this year by 16% after 2 strong years, and many thought that we are not going to continue higher, so they didn't participate in the rally, but the market is defying all expectation and continues to go up. So this is why it's called the most hated rally. Will it go up in the coming few weeks? Let's see that. I have few watch out that you need to take care of. So what happened last week? October ended positively. S&P ended with 2.2% and Nasdaq ended with 4.5%. Yet the S&P equal weight is not participating in the rally, and the Russell 2000 went up by 1.7. We will talk more about the S&P equal weight in this video. The government shutdown continues for 31 days now. This is the second longest. The longest was 35 days. So if we continue the government shutdown this week, it will be the longest government shutdown in history. Fed had the meeting on Wednesday and they announced 0.25% cut in the rate as expected. But the problem was in the coming rate cut in December. So Jerome Powell said two things. He said first, in the absence of government data, you are similar to the one who's driving in the fog. And when you drive in the fog, you have to slow down. He also mentioned that there is a split inside the committee. There are some people who think that we should not cut rate, and there are people who think that we should cut rate even further. So there is a split. He said December rate cut is not guaranteed. Last week, one of the positive news was the US-China deal. And as we mentioned, we have a split in the Mag 7 results. 2 went up, 2 went down, and 1 was flat. So we're going to talk more about that in the coming slides. So October ended in line with the last 10 years median return for the S&P 500. We scored 2.2% and the median was 2.1%. Now November is normally the best month in the year. Will November be in line with the history or not? I have few watch out that you need to take care of. The first one is that we achieved a new all-time high this week. But look, how did we achieve that? There was only one green candle on Monday, and then we had 4 red candles. What does it mean? It means that we started higher and then we ended the day lower. This is not a good sign. And if it happens for 4 days consecutively, this is not a good sign. We have a key support level now at 6740 to 6770, and this is basically this support line and the 21 days moving average, and I expect that they will move together to the 6770, and this will become the exit point. If this was broken, then it's a sign that you need to go out of the market for the short-term trade. The 50 days moving average is going to the 6640, so this is a good exit point for the medium and the long-term traders, and also for the short-term investors. Now let's look at the equal weight S&P 500. And the difference between this and the S&P in the previous chart is that the previous chart was capital weight. The big companies take a big percentage of the index. This is all the companies here in the S&P 500 have the same weight, which is 2.5%. So the S&P capital weight went up by 0.7%. The equal weight went down by minus 2.3%. What does it mean? It means that the big companies are driving the capital weight index up, but most of the companies are not participating in the rally. Most of the companies are going down. And if you see how this happened, last week the S&P went up by 0.7%, and if you count Nvidia, Google, Amazon, and Apple, their share is actually 1.5%. It is much higher than the 0.7%. And even if you take the one that's going down, the net will be 0.9%, which is higher than the increase in the S&P 500. So it is telling us that most of the other companies are going down. The market was only up because of Nvidia, Google, Amazon, and Apple. This is very dangerous sign. Why is that? Because if the increase is spread across several companies, then it doesn't matter if one company went down or not. You have other companies that will help to take the index up. But when it is very much concentrated in 4 companies, this is where the issue is. If one of these companies went down, then it's going to affect the index negatively. Actually, we have seen this happening since 2023. So prior to 2023, we had the capital weight going up in line with the equal weight. And since 2023, we have seen that the gap is widening between the capital weight and the equal weight. It means that you need to be in the big companies in order for you to make money. If you are not participating in the Max 7, for example, or the top 10 holdings that are shown here in the screen, then you have very difficult chance to beat the market. So let's look at the biggest company and see how did they perform last week. Should we get worried or not? So let's look at Nvidia. It went up by around 8% last week. But let's look at the last 3 days. We have 3 red candles and it is ending the week on the lowest point of the last 3 days. This is not a good sign. Now, whether this will continue or not, we need to see this. Maybe it was due to the weekend and the month end. We have to see if this trend will continue this week or not. Next one is Google. When it announced results last week, it went up, but it went up in a not a healthy way. It closed at the bottom of the day, and next day it wasn't able to recover that, and it even trying to close the gap to the 275. The next one is Microsoft. Microsoft announced the results as well last week, and it was going down, and it closed the week on the lowest point. It was negative for the week. Next one is Apple. Again, the same trend. Again, a very big red candle, which is not a good sign, and it's closing in the bottom of this red candle on Friday. Of course, you've seen what happened to Facebook after the results. It went down big time on the results day, and then the next day it continued to go down, and now it's even breaking the 200 days moving average. Amazon, it announced a good result, but similar to Google, it started the day very positively and was not able to keep that, was not able to go above the 200, and it started to go down, which is not a good sign for Amazon. So from the previous chart, you have seen that all the big companies are not giving us the assurance that it will continue to go up. Again, maybe this is because of the end of the week, the end of the month effect, where some funds want to liquidate and make sure that they turn the book profit to actual profit. We don't know yet. We need to see this week, but it is not giving us the confidence that this market will continue to go up. Another watch out is about the new high, new low, and the breadth of the market. So last time we talked about that the number of the companies below the moving average 50 is about 50%. And below the moving average 200 is about 43%. This week, the number of companies below the moving average 50 is about 60%. This is a lot. Only 40% is above their moving average 50. And even the number of companies below the moving average 200 went up to almost 50%. So now we are 50-50 split on the moving average 200. This is not a good sign. And if we look to the new high and the new low, last week we had about 225 companies achieving new high on Friday and only 60 companies achieving new low. This week we have a split. We have actually the new low is higher than the new high. And this is also not a good sign. So we need to watch out. We don't know what will happen, but we are seeing some sign that this rally is not healthy to continue to go up. Last one, we have an indicator called Hindenburg indicator, and it's named after the famous tester in Germany with the same name. So when does this indicator trigger? There are 4 conditions for this indicator to be triggered. The first one, if we have a large number of stocks hitting a new 52 weeks high and a large number of stocks hitting 52 weeks low on the same day. And we have seen this happening last week. The second condition is that the number of new highs and new lows both represent more than 2.2% of all issues trade, and this happened as well last week. The third one is that the Nasdaq index is above its level from 50 trading days ago, which is happening now. And the fourth one is that the market breadth is negative, and we have seen that in the previous slide. So what happened when these 4 conditions are met? We had 70% of the time market is lower after 1 month, and 83% of the time the market is lower after 2 months. So this was triggered last week, and there is a high possibility that the market will be down after 1 month or after 2 months. Of course, this defies what we said first on the historical average, that November is normally the best month in the year. Let's see if this will happen or not. So I'm not saying that this will happen. I'm just saying that we need to take care, because there are some indicators that are showing that this rally is not healthy. Now, moving on to next week, we have the news on the government shutdown. We'll see if they manage to solve this problem or not. And then we have a lot of data that will come on if the government is back to work. We have also very big number of companies that are announcing results this week. So this can also define how the week will go. We have Palantir and Hims and Her on Monday. We have Uber, Shopify, and Spotify on Tuesday before the market, and we have AMD, Anet, and Supermicro Computer on Tuesday after the close. On Wednesday, we have Novo Nordisk and McDonald's, and also after the close, we have Robinhood and Applovin and IO&Q, Qualcomm as well. Thursday, we have Celsius, we have D-Wave, and we have VST. And after the close, we have the Trade Desk, Open Door, and Sound. On Friday, we have CEG. So a lot of important companies that are going to announce next week, so take care of that. My trading strategies for next week, I am in the market, but just watch out for the breadth, watch out for the MAC 7 behavior. If they are continuing to go up or they will have shaky performance, watch out for the results. So you can be in, but just be careful and have your stop loss ready to go out in case the moving average 21 for the S&P was broken. Last reminder on my stocks trading 101. You will have 15 hours live with me. I'll put the link for the video that I explained the training details at the end of this video. It's gonna start next Saturday. We'll have 5 hours every day on Saturday 8th, 15th, and 22nd of November. And the deadline to register is this Wednesday. So make sure that you register and you make the payment before Wednesday. After that, the registration will be closed and you will not be able to participate in this training. The next one is not decided yet when it's going to happen, maybe on Feb or March next year. So this is the last chance to subscribe to this training. That will be it for this week. If you like the video, please press like, share it with your friends, subscribe to the channel, and put any question in the comment. This video is for educational purpose only and should not be considered as a financial advice. Any investment or trade you make is at your own risk. Thank you very much. This was Ahmed Saleh.